Accounts Receivable and AFDA Problem 2. On January 1st, Cherry Company has the following balances. Accounts receivable, $26,000 debit balance. Bad debts expense, $0. Cherry Company has the following transactions during January. Credit sales of $130,000, collections of credit sales $86,000, write-offs of $15,000. Cherry Company uses the direct write-off method. At the end of January, the balance of accounts receivable is how much? This question focuses on accounts receivable, bad debt expense. Students usually, they get really nervous about these topics when they first learn about them, and rightfully so because there's a lot going on. I'm going to help you master this stuff. Now, the first thing to note, again, whenever you have a question, is to look at what the question is asking. At the end of January, the balance of accounts receivable is how much? When you're dealing with accounts receivable, bad debt expense, the first thing to take note of, what method does the company use? If you're not told, remember that under GAAP, companies must use the allowance method. Now, I said that companies must use the allowance method. If a company is not required to use GAAP, it could do the allowance method, but it can also do the direct write-off method. And this company, and I'll show you where, we're told that they use the direct write-off method. Told right here, Cherry Company uses the direct write-off method. So the good news is that the direct write-off method is not near as challenging and difficult as the allowance method. The bad news is that in later problems, you're going to have to go through the allowance method and all the application, because you better believe that if you're taking an accounting course or you're taking an exam or you're looking in practice, you're going to have questions that focus, or you're going to have issues that focus on the allowance method, because again, it's so important for GAAP. It's so important for GAAP. So just a little run through, direct write-off method, all we do is we write off the account receivable when we understand the clients, when we understand that respective client, they're not going to pay it off. So we're told on January 1st, the account receivable balance is $26,000, normal balance, positive balance, and there's no bad debt expense. So nothing has been recorded in as of January 1st. And this company is likely a calendar year, January 1st to December 31st. And the idea is that at the beginning of the accounting year, as you know, expenses are temporary accounts and they start as zero balance. And then at the end of the year, that way we can keep track for that year. And at the end of the year, we close it off after we write it onto the income statement. We're also told that Cherry Company has the following transactions during January, and this is important information. We're told that the credit sales are $130,000, the credit collections of sales are $86,000, and the write-offs are $15,000. To get the ending balance, again, that's what we're focusing on. The ending balance of accounts receivable at the end of January, which all this information relates to January. January 1st, that's our beginning balance. We're going to need all three pieces of information. What I'm going to do is I'm going to take this $26,000 balance. We're going to start there because that is the beginning balance in accounts receivable. If you're asked what is the balance of an asset or a liability or a stockholder's equity or owner's equity account, start with the beginning balance and adjust. So how do credit sales, how are they going to affect the accounts receivable? Well, think about it. Credit sales, they're going to increase accounts receivable because when a business performs on credit, that means that they are going to be paid in the future by their customers. So we're going to increase our accounts receivable by this $130,000. So we increase. Next, collections of credit sales. This means that the company is collecting from the customers what they're owed. So that means the accounts receivable will be going down by that amount. So this is all during the month of January. And again, we're focusing on the ending balance. So we subtract away the $86,000. And finally, we have write-offs. Now again, this is key. This is the direct write-off method. So we isolated, or we determined that $15,000 of accounts receivable cannot be collected. It's uncollectible. Just the clients, the customers, they've disappeared from the face of the earth. They're somewhere remote. We can't get a hold of them. It's not going to happen. Or they went bankrupt and we're not going to get the money because the money was already paid to the other creditors, nothing left. So $15,000 of write-offs, when under direct write-off method, when we write off an account receivable, we reduce the actual account receivable. So we're going to reduce account receivable by $15,000. Now, if we do this calculation, we get our ending balance of accounts receivable for the month of January, and that equals $55,000. So that is the ending answer, $55,000. That is the end balance of accounts receivable in January.